On behalf of ICI Tanzania and Kenya, I wish you all a very pleasant and an amazing time at our conference. I would like to invite CA Manish Bansal to start with our first technical session. Over to you, sir.
Pleasure for me to introduce our eminent speaker who is going to share his expert knowledge on transfer pricing and tax updates from East Africa and beyond. Mr. Rishit Shah, who is the fellow member of ACCA UK. He is also a member of National Board of Accountants and Auditors of Tanzania and a registered tax consultant with Tanzania Revenue Authority. Mr. Rishit Shah joined PwC in 1997 and over the past 24 years in PwC, he served various senior level positions. Currently, he is the partner of PwC Tanzania and head of tax practice in PwC Tanzania. He is a well-renowned name in tax experts in Tanzania. He has developed extensive experience in direct and indirect taxes and carried out a number of advisory and planning assignments for almost all the major sectors of industries operating within Tanzania, East Africa, and beyond. He is also having a high level of experience and being directly involved in several assignments related to restructuring mergers, acquisitions, tax dispute resolutions, tax health checkup of entities, etc. He is also a key member of the Consumer Industrial Product Services section of PwC Tanzania. Although his achievements and contributions and experience in the field of taxation, both direct and indirect, is having a long list to define. Without taking any further time, it's my honor to welcome Mr. Rishit Shah to enlighten us from his knowledge of transfer pricing and tax updates. Over to you, Mr. Rishit Shah, to address the audience. Thank you.
Thank you, Manish. Can someone just confirm you can see my slides?
Yeah, we can see your screen.
Excellent. All right. Good afternoon, everyone. And thank you, Manish, for that explanation. Well, today is actually a historic day. I don't know if everyone's been following the news, but 136 countries in the world have signed an agreement of having a minimum rate of corporate tax of 15%. A lot of you will say it's not enough, but it's nevertheless a historic step. So just 1 minute. Yeah, so I'm just going to quickly look at some of the transfer pricing highlights, looking at the economic first, then look at just a general economy, because I just want to place the economy in context, because it's quite important when I talk about the tax issues. Then obviously transfer pricing being the heading, we'll look at some of the TP highlights for various countries in East Africa and South Africa as well. Look at some of the key changes that happened in the recent budget or finance acts in various countries in East Africa. And then just giving a regional flavor, because we were always comparing ourselves, Tanzania, Kenya. So, looking at PAYE and other taxes, just looking, including VAT. Then talking about regional integration. Today, Kenya and Tanzania have integrated into this platform here. So it's very important about regional integration from tax point of view. And then being from Tanzania and a number of members just being here, I'll just spend 2 or 3 minutes on very big emerging issues that are coming through in Tanzania. So just in terms of the GDP, sorry about that, the GDP, a tale of two cities. If you look at 2020, a number of, that's in orange, you can see a number of countries in Africa had negative growth. This is according to the World Bank. Tanzania, according to the World Bank, had 2%, but we all, widely or vividly follow the Bank of Tanzania statistics, and those indicate, you can see in the left-hand side, 4.8% growth as per that was last year. Again, in terms of projections for Tanzania, there's a bit of variance for 2021. The World Bank forecasting a 4.5% growth, but according to our country's statistics, it's 6% growth. Nevertheless, both in a positive direction. But you can see that South Africa minus 7%, retracting last year. But this year, conversely, South Sudan going the other way, even though they had a major growth last year. So I think it's quite important to understand these growth patterns and a number of countries in Africa having the highest growth predicted or forecasted in the world for 2021. Similarly, just looking at inflation, Tanzania pretty much within the 3.5 or just plus minus there. And I think it's within the parameters the government has set of not going above 5%. I think maybe the outlier is Rwanda. So 2020, despite having COVID, there was huge inflation of 9.9%, but they've now managed to really control that and just 2 months ago down to 0.1% or pretty much flat. Population, again, I think everyone knows Africa is going to be a boom, but you can see that Tanzania, just 56% in 2020, and now, I mean, forecasted to just reach 80 million in the next 10 years. So a huge increase in a lot of these countries means, there's going to be a lot of pressure on governments to even collect more tax to fund the infrastructure growth. And then moving on to tax now, unfortunately, Tanzania, in terms of the paying taxes ranking in Africa, or most of these countries in Africa, is the lowest. But I'm sure, unfortunately, the World Bank have now suspended this paying taxes guide, but I'm sure if it was this year, we could have had a better result given a number of measures the government has taken, which I'll speak about as I present. So in terms of transfer pricing highlights, just starting or kicking off with Tanzania, yes, there is a TP legislation, there are regulations in place. You need to have a local document in place. And if you're making transactions of 10 billion or above 10 billion, then you need to submit this TP documentation with your final tax return. The final tax return is due within 6 months after the year end. If you don't have a TP documentation and the Revenue Authority comes and audits you, there is a fine of an immediate penalty of 52.5 million shillings, which is about $23 million. In case your turnover, your threshold or TP transactions are less than 10 billion, then you don't need to submit the TP documentation. But if the Revenue Authority subsequently comes and asks you for one, then you need to produce it within 30 days. Otherwise, you face the 52.5 million penalty. In the recent budget, there was a penalty introduced for 100% of tax. So if the Revenue Authority makes an adjustment for TP for 10, let's say 10 million shillings, then there'll be another penalty of 10 million that they will apply. Yeah. There is no requirement of country by country reporting, and I will skip that for Tanzania, Kenya, and Uganda, but I'll touch about what country by country reporting is in the context of South Africa, because it's quite important in terms of where the world is going. So there is also no requirement to prepare or submit a master file, but if within the local file there is reference to the master file, then you need to then submit both of them. So I think in terms of related party transactions, the electronic return that's required to be filed for corporate income tax is robust enough where you need to kind of declare these transactions. So Kenya is pretty similar to Tanzania. Not very much difference. You can see there a penalty of Kenya shillings 100,000 or 10%. So maybe Tanzania is a bit more punitive. But I mean, you just need to maintain a TP documentation, but there's not much guidance in terms of whether you need local or master. So I mean, but not very much difference. So you also need to have a TP documentation for Kenya. And similarly for Uganda, also it's very similar to Tanzania, where you need a local file, and upon request within 30 days you need to produce that. I mean, their penalty is a bit less if you don't have a TP documentation or for non-compliance when information is requested, and the penalty is also lower than Tanzania. So just Rwanda doesn't have much. Yes, you need to have a TP documentation report, but there's not much guidance on what is required. The return is due within 3 months. So you just need to have some sort of documentation for Rwanda, but I think the legislation is not robust enough to direct in terms of what is required. So South Africa, both need to be submitted, the master file and local file. But if you look at the bottom of my slide, you can see that there is a requirement for country by country reporting. So this is where, if there's a group, then they need to kind of list that Tanzania, Mauritius, what was the turnover, what was the revenue, number of employees, and so on. And obviously that then can give the revenue authority a good idea where the profits are being shifted to countries where there's not much substance. So if, let's say, South African revenue was shown less than Mauritian revenue, but in Mauritius there's only 2 employees, clearly the South African authority, revenue authority, SARS, would ask questions on the substance of the Mauritian entity and how it's generated those profits. Okay, I'll skip that. So in terms of double tax treaty, I thought it's important just to highlight the number of double tax treaties. And you can see, I mean, we're not too far. I mean, a lot of people complain about Tanzania, but Rwanda, Uganda, Tanzania all have 9 treaties. But I think what's different for Tanzania is that a number of our treaties are very old, and the withholding tax rates in the treaty are somewhat more than actually what is in the income tax legislation. So I think it's quite important. I mean, you've all probably heard about Kenya and Mauritius, the negating that tax treaty. But Rwanda have managed to sign a number of tax treaties recently, so they're really, trying to push that agenda. Unfortunately for Tanzania, not much in terms of tax treaties. A lot of disputes going on in terms of South Africa with the Revenue Authority, and there was a similar dispute in Kenya, but Kenya was ruled in favor of taxpayer. But in Tanzania, on a similar dispute in terms of the South African double tax treaty, it's currently been ruled in the favor of TRA, apart from one recent case. So there is still light at the end of the tunnel. So moving on to the recent changes in terms of budget for Tanzania, the 5 priorities were articulated in the annual development plan. And I mean, it is kind of the obvious, improving the infrastructure in terms of road, providing safe water, education, and then health as well. And last but not least, looking the whole infrastructure agenda of completion of the hydropower dam, Mwalimu Nyerere Dam in southern Tanzania, and the SGR project, this standard gauge project. Now, in order to fund these significant plans, we would say the big 3 changes. I mean, we normally refer to as the big 4, so it's nice to say big 3 changes. So the biggest one was the fuel taxes were increased by 100 shillings. And I mean, there was quite a bit of uproar, and subsequently there's quite a bit that's happened where the government has now tried to scrap off, just last week, scrapping off, in fact, this week, Wednesday, a number of other levies. So in one way, they've reduced one side, but in another way, they've increased one side. But the tax collections for the last 3 months, coming from Tanzania, obviously, I'll talk a bit more about Tanzania. The last 3 months are actually more. The Revenue Authority has just produced the numbers compared to the 3 months, July to September 2020. So fuel taxes have actually contributed to this increase significantly. Then there was a lot of fun and games in terms of the mobile money transfer tax or levy that was introduced in the budget. So initially the introduction was 10 shillings to 10,000 shillings. So about just over $4, those of you who are outside Tanzania. But the problem was that it's being levied when you transfer the money and also when you withdraw. Now, we know in Africa, a lot of money is sent from big cities, to the villages. And that's where the problem is now starting to come, where if I'm transferring to my grandfather in the village, then it's hitting twice. So a lot of people, are questioning this levy or question this levy, and then government sort of intervened and reduced it a bit. But I think there is still a bit of inhibition on this levy, and we're hoping that maybe at least the withdrawal side should be removed, or maybe the transfer side should be removed, because otherwise you're just discouraging people to use this mobile money platform. And it's only for individuals to individuals, P2P, people to people, yeah. And similarly, there was an airtime levy introduced, and a 20% excise duty increase on spirits. So there's quite a significant increase on excise duty on imported spirits. We're trying to industrialize our country. So on the PAYE side, there was a bit of change, reducing that cost, a small change. So all of us are $1 happier every month. So you're getting $1, just over $1, 2,500 shillings. But I think the big positive change was in terms of WCF, the Workers' Compensation Fund. Yes, a small reduction, but nevertheless an important one in the right direction. In terms of the tax administration, so one is mediation. So what's happened is there's been a real big push in the last 3 months following the introduction of mediation. So all the tax cases that are in the tax courts, the Commissioner General is really pushing the agenda that bring them out, let's talk, let's create a win-win situation, let's discuss, negotiate. So we've had significant success in the last 3 months, at least for some of our clients. And even last week, I attended one conference with the Commissioner General, and the message was very clear that let's not, fight on these things. Let's see if there's a possibility. So what happens is you can temporarily reduce these cases or remove them from the tax court. You can mediate with the Revenue Authority. And if you reach an amicable win-win situation, you sign off, you go back to the court and present, and that's it. That's really it. And coupled by that, there is a reintroduction of a waiver for interest and penalties. So this is really helping the mediation side, because there are cases where we faced where you could have an assessment of 300 million for principal tax, but 500 million of interest. Now, there are times when the taxpayer would have settled, but because pre-1st July, the commissioner did not have the mandate to waive these interest or penalties, unfortunately, everything was going to court. And going back 5 years, 7 years to audit. So you can imagine the quantum of interest, how big it can become. There was a removal, we've discussed about the transfer pricing. So there was kind of a removal from the tax, from the principal amount to the tax. So 100% penalty introduced. And given a number of these big development infrastructure projects, there's been a proposal now to give sole power to the minister, so as to move things quickly in terms of these infrastructure. Before, you had to actually go to government and get approval. Yeah, excuse me. And then the ECOP, the pipeline project from Uganda to Tanga, coming through Tanzania. A number of exemptions have been introduced and clarity given on that, so as to just to make things clear and promote that. Kenya similarly had a number of priorities in terms of the big plans, and for them they had a Big Four agenda. We had 5. So implementation of the Big Four agenda in terms of healthcare, security, nutrition, and housing, really, and manufacturing. So the key changes there were introduction of a number of new exemptions, but the biggest change was really that exported services, which were previously zero rated, are now exempt. And this is really, I think this has really happened from my knowledge, that there have been a number of cases that have gone to court there, and the ruling has mostly been favorable on the taxpayer side. And there's been a lot of gray area on what is an exported service which qualifies for zero rating or not. So now all they've just said is any service that's been exported is exempt. Now that's not, it's not a very nice thing, because we know that Kenya is a big player in terms of providing services, in terms of for the whole of Africa. So now, if they're going to be exporting all these services and they're exempt, then that means they can't claim. Most of your accountants, I assume, so you cannot claim the input tax as well. So that's a big hit. Again, the digital economy, everyone's trying to target that. So both for VAT and income tax, significant changes coming up in Kenya to try and increase maybe the what can be taxed and what not, and also providing clarity. And then PE definition change just to align with international best practice. A positive change, tax losses can now be carried indefinitely. So previously there was a restriction, but I'm not sure the reason for the other change. So trying to restrict interest deduction. So instead of before they used to have a thin capitalization restriction. So now that's in terms of that equity ratio. Now that's moved to 30. You can only claim up to 30% of EBITDA. Yeah. And then a number of other minor changes on withholding tax and other allowances as well. Excise duty, so that I'm sure the women will not be very happy. Excise duty introduced on jewelry, but also chocolates and confectionery in Kenya. So yeah, and a clarity in terms of data purchased in bulk internet, where you're acting as a kind of a wholesaler that you're selling to someone else. For Uganda, similarly, that they had a number of priorities. They were looking at, again, digital transformation, which was, I would say, is very commendable. The whole world is going into that, but agro and the transport and power section. A number of exemptions introduced in terms of ethanol, just to reduce the cost in terms of inputs. But on clinker, I'm not quite sure why, but the exemption has been removed. On the excise duty side, that internet data, there has been introduction of excise duty, similar to other countries or some other countries in Africa. You can see, just like Tanzania, they've also increased the fuel tax in terms of excise, and they've now gone the other way. We introduced a tax kind of on mobile phone, but they've now taken away their social media, the 200 shilling tax. There's also, in terms of just classification on income tax, a change in that, and maybe on the administration side, now there is a need, before you apply for your business license, you just need to make sure you have a TIN. And also, I mean, here we had, as I said, there is kind of an alternative dispute resolution process through this mediation. So Uganda have also introduced that. So just moving on in terms of corporate income tax, and you can see pretty much everywhere the rates are 30%. Carry forward the change in Kenya, now aligning with Uganda and Tanzania. Losses can be carried forward indefinitely. But in Rwanda is an outlier. So you can see there 5%, 5 years, sorry, they can only carry forward losses for 5 years. There is some sort of thin capitalization restriction in all the countries, but in Uganda there is based on EBITDA. I mean, in Kenya also now it is on EBITDA. And I think slowly all the countries are trying to promote the manufacturing sector. So I'll just take an example of Tanzania, where you can see a number of incentives in terms of income tax if you're into pharmaceutical or leather business and so on. So, I mean, in the last 2-3 years, they've really been introducing a lower corporate income tax rates depending on which industry you are in. And you can see similarly for other countries as well. Kenya for motor vehicle assemblers, trying to reduce the rate for 5 years from 30 to 15%. So in terms of the payroll, just give me one. Yeah, so payroll taxes. So in this one, Tanzania is the outlier. And if we've broken it up into employer taxes and employee taxes, so you can see Tanzania, social security is 10 and 10, 20%. You can at the bottom. So 10 can be deducted from the employer. I mean, employers to pay, and then 10 can be deducted from the employee. So in total, there is also skills and development levy of 4% that the employer pays. And I just did speak about the workers' compensation fund rate that was reduced from 1% to 0.6. So you can see there quite a bit of tax in Tanzania. But in terms of the top marginal tax rate for individual tax, Uganda leads the pack with 40%. So the others are 30%. But again, as I said, the social security in Tanzania is significant, 20%. And again, with inflation, you pay in Tanzanian shillings. So there's always concern that, when I retire in 40 years or 30 years time, what I'm getting, is that enough? And then the return also has not been that significant. So some of these things we've tried to tell the government to either reduce the rate or try and improve the privileges that individuals get. So in terms of VAT, I think also important just to understand the threshold and the rates as well. So we've just looked at some of the countries in Africa. The session was East Africa and beyond. So we tried to capture. So in terms of the threshold, you can see not too different, but I think a number of countries can push the threshold up. And it's always a debate. Some say push it down so you capture more people into the net, but the administrative cost is significant. And remember, VAT is only on value added. So it's output minus input. So you're looking really at VAT on your profit. So if even though you can have 100 million in Tanzania as your turnover, if your profit margin is maybe just 5%, then that's 5 million. 18% of 5 million, you can do the maths. It's not a lot of money. But then the whole year you have to file returns. The revenue authority would audit you. So both sides, a lot of cost. And you can see the rate. I think Tanzania and Uganda and Rwanda have the highest rate. There are times when I'm asked, if there were changes that you'd propose, I always say the best is increase the VAT rate. So even though we're the highest, increase it to 20% or even 22% because it's easy to collect. But then go on the corporate tax side and the individual tax side and reduce that, because that will promote more people to come into the formal sector, account for PAYE and NSSF and SDL properly on the full payroll cost, rather than sometimes where some rouge taxpayers are not doing the right thing and only accounting part. So I think regional integration, I can see the time also. So I think everyone has heard of the Africa Continental Free Trade Agreement. We, Tanzania, are the last ones to sign off recently, a very positive move. And I think the benefit is enormous. So at the moment, between Africa, the trade levels in terms of import and export is only 15 to 18% overall, compared to Europe, where in Europe, inter-country European countries are doing over 65, 68% that you can see. Asia is nearly 60%, America over 50%, 55%. So I think the idea is that really this is going to be the game changer for Africa. It's going to really help us support our brothers and sisters within the African countries. It will push the manufacturing side, it will encourage manufacturing, it will encourage exports. So a very, very positive change that's come through. And I think it's really going to help. You can see this whole cocktail of, we are part of SADC and East African Community, but we're not part of COMESA. Uganda and Kenya are part of COMESA, they're not part of SADC. So all this whole cocktail, you can see it's really funny map. I mean, it's an interesting one. It's going to help Africa now become one in terms of free trade. So just using Tanzania as maybe an example, I'll wrap it up. One slide, my last slide. So we've spoken about mediation. For my fellow accountants in this seminar, those of you in Tanzania, please use the recent mediation. If you have disputes, even at objection level, even at the court, we have really seen TRA come up with a wonderful result for a number of our clients. So use this, take advantage of the interest and penalty. And remember, TRA have had the most 3 wonderful months. So they're very happy. at the moment. So this is the right time to go and see the Commissioner General or Commissioner and try and get these, your disputes sorted out. In terms of audits, they are continuing. We still see short time frame period given to taxpayers to respond to audit findings. But one thing we are telling everyone is start doing those reconciliations early on a monthly basis. PAYE to your employment cost, to your returns, VAT to EFD to turnover, and this applies to all countries in Uganda, Kenya, so those audiences in those countries also, Uganda now also have this alternative dispute resolution process. So I'm sure it's now an avenue to go and sort things out. And in terms of audit, just make sure you're complying, because once assessments are issued, then remember there is 1/3 tax deposit payable. So in terms of other changes, we've had e-filing, a bit of teething problems on the corporate tax initially, similarly with withholding. But I think it's a matter of time that withholding will now be fully embedded in the new system, and VAT will move from the old platform to the new one. And it's wonderful because remember, a lot of disputes last year were documentation, proof of payment. Have you filed a return? Now everything is on this platform. And talking to my friends at TRA, they've even said that this platform is even going to be further enhanced, where taxpayers will be reminded, and you'll be getting emails and all sorts of things. You can actually go and see a number of things in a more enhanced way. So they're really trying to engage with the taxpayers through an electronic means, and I think we should commend them. Another place to commend is VAT refunds. So from May, a lot of refunds have been paid. The last time the Commissioner General gave a figure in last week's conference was 500 billion. And they're saying that 80% of all non-extractive refunds, so not the mining, but anything else, will be paid by December, 80%. Also, going forward, all VAT refund audits will be on risk-based. So another important change or positive change, because remember they were doing 100% audit for Tanzania. In terms of CIT, yes, the COVID effect maybe is slowly changing, but for the hospitality, just taking an example, you still need to be careful in how you're going to be filing your corporate income tax, installment tax returns. So in December, if you're a December year end, you need to really see, because you don't want to overpay corporate income tax because refunds may still take time. And I think everyone faced a tough time in Tanzania on agency notices, but these are gone for good. And that's our understanding. So with that, Mr. Kapil and Manish, thank you very much. I end my presentation and I welcome any questions.
Thank you, Rishit. It was a very nice, short, and very meaningful presentation for all of us.
Thank you.
Manish, you have some questions, I believe, from the audience.
We have few questions from the participants. First question, okay. One of the participants, they have asked on the transfer pricing policy. They are saying that there is no specific format of transfer pricing policy which is specified by the TRA. Each consultant or the company, they having their own formats. So what is the minimum requirement by the TRA to be incorporated on the transfer pricing policy? And do we need a consultant to prepare the transfer pricing policy, or shall we do in-house also?
So, okay, our recommendation is you can, if you have a good tax consultant, you can do in-house. The regulations do prescribe what needs to be covered within the transfer pricing documentation. But I would still recommend, and it's not because I'm a tax consultant, that just get, even if you prepare it in-house, at least the first one, get it reviewed by a tax consultant. And then the subsequent ones, you just need to roll them over if there's not significant change. But my idea is, as you said, there are different formats. But all in all, I think everyone covers everything in a different way, same way or different way, whatever you say. But yeah, but one thing on transfer pricing I forgot to say is the revenue authority in Tanzania is now really focusing on local transactions. A lot of our local Indian investors may have 2 or 3 companies here in Tanzania, and some of them are taking it lightly. But the revenue authority has now really started focusing on company within Tanzania. So please also make sure your TP documentation covers everything. And it's available, because it is not possible to prepare a TP documentation in some instances within 30 days. So don't wait till TRA comes and knocks the doors. Please prepare it or engage with your tax consultant to prepare it. Thank you.
Thank you, Rishit. There's one more question on the double tax treaties. They're saying like Tanzania is having only 9 countries with the double tax treaties, whereas Kenya is having 15 and other East African countries also having more than 10, 12. So is our government is moving towards to include more countries on the double taxation treaty? Why the East Africa is having a minimum number of that?
Yeah, so I think everyone is skeptical about these double tax treaties, so with BEPS and all these things happening, that's also a reason. And double tax treaties in some instances are becoming unpopular. Now, for Tanzania, we've not signed any double tax treaty for years. As I said, apart from the India one, maybe to an extent Zambia and South Africa, the other 6 are very old and don't cover most of the things. So our engagement with the revenue authorities that there is no appetite, I don't think, for at least in Tanzania, there's no appetite to sign any other. We have one member of staff who used to work for the Ministry of Finance, and she used to be dealing with double tax treaties, and even kind of she's indicated that that appetite has now gone down. Yeah. So I think the one that we really need to push as accountants when we're talking to government is the East African one, because with the whole free trade agreement, I think it will complement, and I think within East Africa, as I said, we are brothers and sisters, and we need to help each other out. So there is too many taxes. Withholding taxes are high, and if you look at now the CSC rules that Tanzania has started to, the TRA has now started to question or apply. There's no motivation for a Tanzanian company to invest in Kenya if the revenue authority is now going to start double taxing profits from Kenya. Yeah, thanks.
Thank you. There is one more question from Mr. John, who is from Arusha. He's asking, in all the East African countries, do we have a common penalty system to avoid the tax avoidance? Like each country, they're having their own penalty system for the various taxes compliances. So in the future, after the signing of agreement, do we have a common penalty system?
So no, we don't, because everyone has their own acts or administration acts. But there is talk going on having a number of these acts to become one. So I think there is a discussion going on the VAT one, definitely. I'm aware of that. And the excise one, because the excise is kind of complementing the customs one. So I'm hoping that once those two are maybe done, the excise and VAT, maybe they'll also start thinking about the tax administration side. And then what that means is the interest and penalties will be similar. Yeah, but again, these things take time. And at the moment, I would say the climate is good. Things are happening fast. So maybe this is the right time again, whoever can influence this, but it's a good suggestion.
Yeah. Thank you, Mr. Rishit. This is the question was asked by Mr.
Manish, allow me to ask a question to Rishit sir directly. Rishit ji, you mentioned a bit about the local companies being audited for the TP, I mean the related party transactions. So we, like, consultant like you and me always think of two things. One is there is no threshold in our TP regulations. Number two is when it comes to the local transfer pricing, like the local transaction between the two entities, if both the entities are in the profit making entities, is it not a good ground to argue not to make any adjustment? What is your viewpoint on that? I understand if a company is in loss, another in profit, still, there is a planning some doing on, but if both the entities are profit making and still TRA wants to make an adjustment, is it not a good ground for us to argue that it is not fair? And how do you see it? And the threshold, like there is no threshold, is there something being done on that?
Yes, I think Kapil, yours is more of a comment rather than a question, because I fully agree with you. It's something, one of the recommendations that we've made time and again to the Revenue Authority, that all you're doing is just increasing the administration cost for everyone. I mean, it's very similar to the 5% withholding tax on professional services for VAT registered companies. We kept on saying that if you're VAT registered, you have to issue an EFT, and you're now bringing in a very nice platform to capture everything. Why have the 5% withholding tax for professional services? You're just adding to the cost.
Right.
Yeah. So so very good point. Yeah. Thanks.
Thank you. Yeah, Manish, please.
Thank you, Rishit. This is the questions which are asked by the participants.
I think now, Manish ji, about the token, if you can ask him to.
Rishit, thanks for your participation. We have sent you a appreciation token. If you can show to our participants.
Thanks. This is the most important part of my presentation. So they've given me a nice letter, and I'm going to try and now see if I can. Oops. Yeah, there it is. Maybe I need to be closer. Yeah.
If you can open it, Rashid bhai.
Oops.
This is something from the Africa flavor.
Yeah, I don't know if you can see it from the background, but with the background on my background, sorry.
Yeah, it's fine.
So thank you so much, Kapil and Manish. Really appreciate it.
Thank you. You're more than welcome, Rishit bhai, and we'll continue to engage with you in our, the individual events also.
Yeah.
Thank you, Rishit, for accepting our proposal and giving your valuable guidance to all of us.
Thank you.
Thanks.